Right, we're going to get started today by looking at the S&P 500 like we usually do. You can see that we've been overbought for at least 5 months now, but you can notice that today we had a threat by the president to impose 100% tariffs on the Chinese. That threat seemed to have caused a sell-off in the stock market. You can see that we went below the 20-day exponential moving average. I've been saying for quite a while that we have this support at the 20-day exponential moving average going way back to April. Um, we did cross through the 20-day exponential moving average here, and we touched it here and here. Um, but we're actually at right now the 50-day moving average. So anytime when the stock market sells off like it did today, you have to look at what kind of support there is in the market. And when there's okay, we have an uptrend in all of our moving averages, which is positive. And but we did lose a little bit of momentum on Friday. So let's look at a major news story for Friday. Dow drops almost 900 points. S&P 500 declines the most since April. So we have like a bit of a deja vu. The front page news story was Trump puts extra 100% tariff on China imports, adds export controls on critical software. So whenever I listen to that, I think that could be just a negotiating ploy. Um, and we can't take it seriously, because it's fool me once, shame on me. And this market is just so on the edge because a lot of people in the market or on TV are saying there's a bubble in the market. So any chance of a news story to make the stock market go down, this um, market goes down on just the simplest idea of a bad news article. So look at this. Tech mega caps lose 770 billion in valuation as the Nasdaq suffers the steepest decline. Um, what other news stories we have today? Okay, Chinese stocks slide as Trump threatens tariffs, accuses Beijing of holding world captive. So what's happening is the Chinese are putting controls on who can buy the minerals that are necessary for powering a lot of the the electrical vehicles around the world and defense businesses. So there's something called rare earths that China has like a monopoly on right now. They have 90% of the world's manufactured rare earths, and they're limiting exports to America. And Trump doesn't like that, and he's trying to get that opened up. So that whole event, all this news that came out made the stock market, let's see, what go down 4% in the Nasdaq. That's a lot. S&P down 2.71%. So um, so just it's just in times like this, you got to think, how does this affect the stock we're investing in? And a lot of the chip stocks today took it on the chin because uh, a good part of the revenue of some of the chips companies are selling to China. And if you take that away, then they are less profitable. So let's look at some of our talking points. First of all, this is the S&P chart. We can see we had an uptrend, a perfect uptrend, hitting the trend line at the bottom every mark except for this past Friday. You can see, I'll zoom in just a little bit so that we can see a little better. You can see this trend line was perfectly drawn for the most except for this April time. But you can see we went through that, but we hit support at the 50-day moving average. The next level of support is the 100-day and then the 200-day moving average. So you can see a lot of people selling. Look at that. The last time it sold off in that extent was right here. We went right down to that trend line. And so just keep that in mind as we go through and talk about things. Right now, October is traditionally a good month, and that's because we have earnings season start. So their earnings are going to be coming out this coming week. We have the banks, most of the banks reporting, and they always start earnings season off. We have Citibank, JP Morgan, a lot of banks. Um, that's for the most part who is the big companies that are going to be reporting this week. Then we have tech stocks are going to start reporting the last week in October. Then we have Google November, and then later on we have NVIDIA. So a lot of times the earnings are a good catalyst for stocks to go up. And banks have a lot of tailwinds that they'll probably do good because they have a lot of underwriting. They have there's a lot of trading activity. So and the yield curve is in their favor. So all in all, it seems like the banks are going to help the stock market go back up again. So that's why I have green for like the whole month of October. The one thing to keep in mind is October um, has a bad reputation. Two of the biggest crashes in the world in 1920s happened in October, and we had the 1987 crash happen in October. So there's a little bit of um, antsiness when the month of October comes around. But um, I go by the averages. When we look at our monthly averages, it's usually a 1% return. But you can see in the VIX composite activity that the VIX is the highest in October, meaning we expect a lot of volatility. So we expected volatility this month. That means stock market going up and down a lot. And we expected it to be doing good. So just keep all that in mind. What else do we have to look forward to on our calendar? We have, after earnings, we have Thanksgiving. That's the purple here, that's the last Thursday in November. And then we have Christmas and we have New Year's, three big holidays. A lot of times the stock market goes up around those times. All right, so let's look at the earnings that came out this week. A lot of very small companies, um, not big, and it's not even worth really talking about because they're not really market moving. But if you look in this coming week, we're going to have a ton of bank stocks reporting on Tuesday. We have BlackRock, JP Morgan, Goldman Sachs, Citigroup, Wells Fargo, and they're kicking off the earnings season. We have Charles Schwab a little bit later. Then we have TSMC, Taiwan Semiconductor, we have CSX, and we have American Express. A lot of other banks you can see reporting at the same time. So a lot of times, if the banks give reports that say how good the consumer is doing, and a lot of times that gets the stock market going again when they see good earnings and good things about the economy. Let's look at our numbers for this week. We had a huge drop in our 50-day moving average. So only 36% of the S&P is above the 50-day moving average. And according to our chart, that 30%, we're right on the edge of being a bearish stance for stocks. But the 200-day, we have 54%, which is more bullish than bearish. Okay, so let's look at let's look at the U.S. Treasury. It's interesting. we've been falling in the U.S. Treasuries, um, and we this week we had a one-to-one correlation. The Treasuries went down and the stock market went down, but the S&P might have went down because of our drastic news story that happened on Friday. I don't know, but the correlation was inverse for quite a while. So let's see if the inverse correlation can come back next week. All right, so let's look at some of our major variables. Oil. Why would oil be down 3%? If there is a trade war, um, a more severe trade war between the United States and China, where say the United States has 100% tariffs, then there'll be less economic activity in the world in general. And when there's less economic activity, then the price of oil goes down. So that's been one of our equations for a while. Either the global economy is slowing down or there's more supply on the market. So this week it's down most likely because global economy is slowing. Um, let's see, inflation is still around 2.9%. Um, doesn't seem like tariffs are affecting inflation at all. The US dollar index, it's up 1% this week, but it's still in a downtrend, you can see. Um, Gold is up 3%. Why would gold be up 3%? Number one, there's a constant um, purchasing of gold by central banks. And that's demand from large buyers could be a part of it. The dollar going down. Our formula is gold is generally dollar denominated. A stronger US dollar tends to drive gold prices lower. And we know the dollar has been going down, so that could help the price of gold too. And let's look at what else we have to say here. Fear and greed index. We have fear in the market for the first time in a really long time. Um, let's look at that just for fun. Well, okay, we've been at greed neutral for quite a while, but not at fear. So let's see, the fear. Last time we had really had fear was um, probably back here a couple months ago. Let's look at what the amateur investor AAII survey says. It says we're more bullish now. So our translation is bullish, caution, take some profits off the table or don't buy. Okay, so we have VIX. We have a big jump in the VIX from 15. No, wait, we went from 15 to 21 now. So that is a big jump. It is 21 now. It was 15. So people are starting to get fearful in the market. Um, okay, people are return to a fearful mode. So I put the X over here. So when the stock market is fearful, that's the time when we start looking for things to buy. When it's capitulating, Jim Cramer would say, that's the time when you hold your nose and buy something. Let's go back and look at some of these news stories here. We have a couple big effects on the market right now. We have a shutdown by the U.S. government. So the economy in the United States um, is kind of supported by the U.S. government. So the government has spends a lot that funds companies. So in general, the economy is slowing whenever the U.S. market is shut, the government is shut down. So that's why the price of oil most likely is down because there's a slowdown in America now. And let's see some more things here. We see rare earth stocks jump after Trump says China holding world captive with his strict controls. We'll go over rare earth later on in our talk. Rare earth stocks are not rare as they're not critically endangered material. They're just hard to process. They are um, elements that come from mining, and you have to refine them, and it takes a lot of effort, and it's not very good for the environment. And till now, China has been doing a lot of the refining of these critical minerals, and so now the Americas investing in some of the rare earth mining stocks so that they can be profitable. So I'll go over those a little bit later. Most of them are not profitable right now. They are losing money, but there's going to be price controls allowing them to make money. So we'll look at those. Um, let's see. Okay, look at this. Pepsi is up 3%. It seems like what's happening now, whenever the AI trade is selling off, we have the opposite side of the spectrum doing better. So let's look at our right here. This was basically the tail of what stocks were going up and down today. The stocks going down the most were the ones that were overpriced, basically, that are trading higher as a percentile versus history. So IT has been trading almost double the 10-year and 30-year average for that type of stock, whereas the energy has been trading about half of its normal valuation. So I guess according rats, rats, I didn't mean to do this. Okay. So you can see energy, financials, healthcare, real estate are some of the more outperforming sectors today. All right, so let's go back. Okay. So we still have a pretty high PE right now. Our P our PE ratio is around 25.65. No, for a second. Is 25, that is pretty high compared to the average of 16 over the past 80 years. So you have to keep in mind we are trading at a high multiple right now compared to history. All right. So if we have a couple of news stories that lead to a lack of confidence in the stock market, people will not pay as much for stocks, and you will have like this readjustment to what people are willing to pay for stocks. And let's look at the worst to first. The best performing stocks last year, 39%, 37%, 30%. Communication services and IT are doing, and utilities are doing the best. They're all up 19% this year. Um, the ones doing the worst last year are now the worst performing sectors this year also. So it seems like we're having some kind of repeat of last year. Everything is very, very similar, actually. All right. But right now, what's happening is the sectors that have been underperforming this year on a bad day are outperforming. So let's look at some of the stocks going up and down today. Okay, we have market movers. Pepsi, this is one that's been down for quite a while. Let's look at Pepsi's let's look at its chart. Pepsi. You can see that we had this downtrend for the longest time. Right here, we broke out of that downtrend. See it's down. And now we're starting this uptrend. This is a very conservative stock. It pays a small dividend, like a 3% dividend. But um, in times when there's economic uncertainty and maybe the president saying something, um, this is a conservative stock, and this has a tendency to go up. So this has been an underperforming for the past couple of years, but it's starting to be an outperformer. And you can see it's starting this new uptrend. Let's look at another stock from today. The AutoZone. One thing most of these have in common that are going up. These are products. These companies sell products that are in demand in good times and in bad. Think about it. We have AutoZone. We have taxes on the imports of cars. People want to make their cars last longer. There's a steady demand for used car parts in good times and bad. That's why they both are going up. These O'Reilly and AutoZone. People are still going to be smoking, maybe even more when times are bad. We have Pepsi. I guess people are going to continue to eat chips and soda in good times and bad. Campbell Soup. They make soup. Duke Energy. People don't have a choice of having energy, so there's still a high demand for energy. Southern Company. Okay, CBO Global Markets. Why would CBOE be up? Well, when there's market volatility and there's a big sell-off in the stock market, they make a lot of money because there's a lot of trading. We have Consolidated Edison. We have a lot of energy companies. Consolidated Energy. We have we have Duke Energy. Okay, Republic Services. Why would they be up today? Well, in good times and bad, people need trash collected. They have a duopoly with waste management. So that is a very good reason why it's a conservative stock. All of these stocks are very conservative. General Mills and CVS Health. The ones doing the worst today, Synopsys, Mosaic, Teradyne. We have a lot of chip companies in our top 10 decliners. Supermicro, they do AI. Robinhood. Some of these companies like Robinhood have like exponentially gone up in price. So there's a lot of profit taking now. So a lot of these companies in the top 10 have gone up a lot. Let's look at AMD. They went up like 60 or 70% in the last month, like an amazing amount. So there's profit taking happening now. Okay, let's look at the sectors going up and down. Before we do that, let's look at the 10-year. We can see that there's a downtrend in the 10-year. Let's look at our let's look at our cheat sheet for going down. Yields of the 10-year going up, yields of the 10-year going down. So we expect small cap stocks, any stocks that are heavily indebted. Well, you know what? It's not going to work like that today because all stocks are like selling off that have to do with whatever Trump said about imposing 100% tariffs. So we might have a little hint of this, but right now the big news story is any stock that's affected by 100% tariffs on China is going to go down. Let's look at that as our theme for the sectors. The sector going down the most are semiconductors. That's because they're right in the crosshair of a trade war with China. Um, Oil services. If the economy of the United States is slowing due to a government shutdown and we have a trade war, um, the economy is slowing. So there's not going to be as much oil being used in the world. So lack of demand, and you have a lack of profit for these companies. Oil, same thing. Telecom, if the interest rates are going down, you would think that telecom would be going up due to higher demand. So that doesn't make sense. Because also telecom is a conservative sector. So if people are worried about the stock market crashing, I would think that they would be going into telecom stocks. So that's an anomaly for me. Regional banking ETF. We do have some news stories this week about losses in the private credit market. There have been some companies that are private that are borrowing money and they went out of business. I think First Data, I forget the name of the company. Um, but there is a fear that some of the banks might be hurt by some of the losses in the most recent bankruptcies. And that could be like a black swan starting. So we'll keep an eye on that private credit world. In the meantime, we have technology sector, bank, ETF. Okay, let's look at the ones going up the most that are holding up. Gold. Why would gold miners be going up today? When there's uncertainty in the world, whenever Trump is making demands with tariffs, and we don't know anything about the stability of the world's markets, people flock to gold. So we mentioned that gold was up this week, and um, one of the reasons why it could be up is um, it's a place of safety. It's a place that people know that if they put their money in it, it's still going to retain value over time. And that's been true since the year zero in the world. Consumer staples. Okay, that they pay a dividend and they're very conservative and they're out of favor. That's why they're up today. Gold miners, we just talked about. Utilities. Whenever utilities go up and the tech sector goes down, that combination is usually an indication that the stock market is bearish. Okay, so let's continue in home construction. When interest rates go down, that should be good for home construction. And that's probably why it's outperforming today compared to the other stocks in the stock market. All right, that was good exercise. Let's look at Dan Now's picks from the beginning of the year. ADTN dropped like a rock recently. Now it's only up 3%. Cisco is 15%. KBWB, the large cap bank ETF, up 17%. And the IJJ, which is the mid cap ETF, is only up 0%. So that's his worst performing sector stock. Um, all right. So let's look at some stocks I had on my radar. Um, you can see a lot of our best performing stock sectors this so far this year have dropped out of their channel, and this doesn't mean it can't go back into its channel, but they basically stopped at the 50-day moving average. This is the same as the S&P 500. So we do have support there, but you can see that we are totally oversold in the communication sector. So I like to point out whenever we are oversold. Let's look at this consumer staple ETF. It actually went up a little bit today, but you can see it's in a sideways pattern for at least a year. And it's at the bottom part of its channel, and it's oversold on its way up. So this is a good um, sector to have whenever you're looking for dividends and maybe growing 2 to 3% a year. So the dividend part of your portfolio is um, it's important to have that so you have a little bit of balance whenever stock markets gyrate. But you can see we're in all the moving averages are pointing downward in this sector. So that's not a healthy chart. Whenever this starts baselining and starts going back up again, that's usually a time to start looking at stocks in this sector. Let's look at AbbVie. AbbVie is it's a drug stock, and you can see it's in a uptrend starting way back last year at this time. But we have this um, positive positive momentum, and they had a really good earnings report. They pay a 2 or 3% dividend, so it grows like 13% a year on average. But you can see that this is one of the stocks, only stocks that we're following that's in an uptrend. It's a little bit oversold right now. You can see that its stochastics are actually they're at 48. So that's right between, that's halfway between overbought and oversold. That kind of matches where it is in our trend lines. It's almost halfway between overbought and oversold. Let's look at the next one, Alphabet. You can see that it broke through its 20-day exponential moving average on Friday, but it's still way above all the 50-day moving average, 100-day, and 200-day. And it's halfway between its trend lines. So, but it's totally oversold right now. It's totally out of favor. Um, let's look at AT&T. I would think that AT&T would be a beneficiary of market gyrations. I would think it would be going up. It went up just fractionally, maybe 0% Friday, but you can see it's oversold and at the bottom end of its range. Let's look at Meta. Meta is another one that's oversold right now. It is a stochastics of 27. So that is oversold. We're nearing the we're near the bottom of this uptrend we've had since beginning of the year. And we're kind of right on the edge of the 200 the 100-day moving average. And we're at kind of near the trend line. So far, this uptrend from last year is still intact. And let's look at the next one, Netflix. You can see that Netflix is still in an uptrend technically. It hit the bottom of its trend line and it was oversold last week. But now it's like halfway between overbought and oversold. So it's not a really good time to buy it right now. Pepsi, we already mentioned this one. This one is um, it's halfway between overbought and oversold, and it's doing good now because of the um, uncertainty in the market. This is a staple. It's is more this safer investment. Let's look at Visa. Visa continues to chug along. Look at this trend line. This is the most powerful stock we're following because it's maintaining its trend line going back a year. It's overbought right now, but on a pullback to maybe like right here, it seems like it's a good for me. It's a really good at least 10 or 15% performer over time. And let's look at the next one. Walmart. This is an example of a very conservative um, stock. It pays like a 2% dividend and it grows at like maybe 7%. So it's not growing a whole lot, but it pays a dividend. A lot of people hold this just for the dividend. Look how long it's been in this pattern right here. It's been in this sideways pattern for almost since beginning of the year. Um, so in bad times like we've had on Friday here, people will flock to more conservative investments like this. Let's look at MasterCard. MasterCard is an uptrend, very similar to Visa. You can see it's at the bottom end of its range, and stochastics are around 50. So it's halfway between overbought and oversold. MasterCard's growing like 20% a year, their earnings. So it's one of my favorite holdings. We have eBay. Why would eBay excel in an environment like this? Just think of how many people are laid off, how many people fear of being laid off. And just think of all the taxes that are being applied to some of our products due to tariffs. And people need a way to buy items less expensively and with less money to use. So that eBay is one of the perfect beneficiaries of the tariff environment. And let's look at NVIDIA. You can see that NVIDIA pretty much it still hasn't broke its 20-day exponential moving average. And that is sign of strength in the stock. And it went down 5% Friday. So that brought it back down to all of its moving, no, it's 50-day moving average, it's 20-day exponential moving average. We have a lot of support there. You can see that it's overbought. It's 75 on the stochastics. That's high. So it's overbought. We have it's at the bottom of its trend line right now. But this is an example of a stock that's growing around 50% a year. It's fairly valued because its PE is around the same as what it's growing at. Let's look at Eli Lilly. You can see it's like in a sideways pattern. It's nearing the top end of its trading range and it's overbought. So it's not a good time to buy this. People were buying this whenever we had the sell-off recently. Okay, so let's look at T-Mobile. We'll go over T-Mobile a little bit later on today, but you can see it's way oversold. It's stochastics. No, it's not oversold. It's 71 on stochastics. That's halfway between overbought and oversold. But you can see in our chart, it goes back a year. Um, this is called baselining. It's the longer the base, the higher in space. Louise Yamana said that. So we're at the bottom end of this channel here we've been in for a long time. We're going to look at this stock in detail later on because it came up on our stock screen again this week. Let's look at this one. Capital One Financial. Okay, so we have it's totally oversold right now. Totally. Look at this. Stochastics at 14. You can't get lower than that. It's totally out of favor right now. Keep in mind, they bought Discover. They're going to be having some synergies from that acquisition, and they're trading below their growth rate, which their PEG ratio is less than 1, and we have banks earnings coming out this week. So as soon as the banks start reporting good earnings, which they should, that could allow this to get back into favor again. So I'm a big credit card guy. I have Visa and MasterCard in my portfolio. I like the idea of charging a toll. This company is starting the ability to charge um, on their own network. Their Discover network is very similar to Visa and MasterCard. It's a self-branded. So there's only four of those in the world. We have Amex, American Express. We have um, Capital One, Visa, MasterCard. That's about it. All other cards in the world are owned by banks. Like banks have Visa and MasterCard, and maybe sometimes American Express cards. So um, it's kind of a unique property here, this Capital One. Let's look at our stock screen for this week. We have T-Mobile up on the highest ranking. You can see it says it's growing. Their long-term growth is 14%. Return on equity is 19. Cash flow growth rate is 19. So those numbers look pretty good. We're going to look at that again. And Micron, you can see that according to Fidelity, they have a 0.15. We went over that last week. We're not going to go again this week, but um, DoorDash, they are on sale by around 9%. So we're going to go over DoorDash again just to see, if they went down some, if it's worth looking at. And we went over Barclays last week. Let's look at T-Mobile. And we mentioned it's in a sideways pattern and it's oversold right now. But they are really doing good with their earnings reports recently. According to Morningstar, they said T-Mobile's earnings taking share without excessive discounting. And so they're raising their fair value. They say full, they're basically fair value right now. They said that T-Mobile reported a strong rebound in customer growth, adding 830,000 net postpaid wireless phone customers, the second quarter record. Record per phone customer also jumped 3% year over year, driving 6% service revenue growth. Phone subsidies increased slightly, but the earnings before interest EDA margin held steady. Okay, so it seems like they're fairly valued according to Morningstar. According to my calculations, they're growing 13%, 20, and then 17. So if you average that together, probably around 17 they're growing at. And they have a 1.78% dividend, so they have almost a 19% total return. So if their PE is 17, a total return of 19, um, their PEG ratio is 0.9. So they're around undervalued by 10%. So this could be a good idea for a conservative part of your portfolio and part of the dividend part of your portfolio too. So it seems like they're growing around 19%, and Yahoo Finance thinks they're 20% off. But look at their profit margin, 14%. The return on equity is 19. Those are both acceptable in our worlds. And they have a lot of debt. They have um, almost half of their market cap is in debt. I guess they took on a lot of debt to buy Sprint. So what the theme is for this company is most likely they're going to be every earnings call they're saying we're going to be repaying that debt, and um, hopefully over the next couple quarters we're going to see this go from 118 maybe down to 100. Um, that's going to be a big thing to look at as an investor, that they continue to work to pay that debt. Um, so let's look at the pros of this company. They're a domestic company. There's no sales overseas, relatively speaking, not affected by the tariffs because it's an American company. Okay, the network ads are great, it seems. They have a new iPhone that they're presenting to people that could be excited about it. Promotionals are, they're making promotions where you get a free phone if you sign up for service. Um, and they're taking market share from their competitors. In this market, it could be considered a growth stock that is conservative. There's not too many of those out there. Let's look at what we already looked at this. Let's look at what CFRA says about T-Mobile. They have a strong buy with a price target of 270, higher than it's at now. They say our strong buy recommendation reflects our expectation that T-Mobile will continue to outgrow peers. We expect competitive pressures to remain fierce, but positively view free cash flow growth potential in churn. T-Mobile's 5G network is ahead of both Verizon and AT&T, which combined with its aggressive pricing plan has enabled it to capture market share while competitors struggle to keep up, often resorting to promotional activity with customers. And whenever AT&T runs their ad to sell their iPhones, and give away their iPhones, that's hurting them in their profitability. So so it seems like they got a good product, the best product, and they have a good marketing team. That combination is allowing them to grow like 18%. Let's look at what CFRA says about their fair value. They say they're overvalued by 10 or they're overvalued by 6%. So I take that as they think they're just about fairly valued. Um, we have some inconsistencies here. Look, they've been unprofitable. Have they been? They haven't had free cash flow until last year, 2 years ago. That's strange. But now we look at this. This is their earnings. They're not very consistent. I expected a straight line up, growing like 10% a year. Perhaps when they acquired a company, they weren't as profitable. I'm not sure. But the return on equity, that is really good. This means 4, 18, 5, 4, 3, 12. Okay, they've had increases in their return on equity recently. But that could mean that they're becoming more efficient and a better run company. All right, let's look at DoorDash. You can see they have a perfect uptrend from beginning of the year. They're halfway between their overbought and oversold right now. 50 is halfway between our stochastics. So that's called no man's land. I like to buy whenever they're at the bottom of their channel and when we're oversold. So, but let's look at their numbers again. It seems like they're growing from last year to this year. They grew 726% their earnings. This year to next year, they're growing 60% and then 47%. So if they're growing at 60%, their PE ratio is 62, their PEG ratio is 1. That means they're fairly valued. A good thing is they have 67% of the market share of food delivery in America. They're domestic. They don't have to worry about tariffs. Grocery and convenience deliveries are growing in triple digits. So this is interesting. They're about fairly valued. So I like to buy it when it's half price or um, right now we're going to keep on reviewing this until it goes on sale. CFRA says that they're a buy. They say our buy rating reflects Dash's dominant position with 67% of U.S. market share, creating a powerful network effects. Non-restaurant verticals represent the key growth catalyst, with grocery and convenience experience triple-digit gains in growth. We think these categories could represent 25 to 30% of global money they take in by 2027, up from 15% today. So they have some growth areas that's get excited about. And CFRA didn't have a fair value calculation, so that does give us a good feeling in our stomach. Um, but let's look what Morningstar said. They said food delivery king crushes quarter, increases fair value from up 10%. So DoorDash, after reporting second quarter earnings, where it beat management guidance for gross order value and reaching the equivalent of a full year 2020 total orders, frequency, and revenue per share also made it to high. Okay, so they had a really good earnings report, and they think it's 26% overvalued. So along with the last um, news story, I think I'd hold off on this right now. Okay, here's the story right now. Rare earth stocks jump after Trump says China holding world captive with its strict controls. So the stock market dropped whenever there is this um, news story about tariffs and rare earths. Um, we have all the stocks that make rare earths or have something to do with rare earths went up a lot, sometimes up to 14% earlier in the day. Um, so as this news story, if it gets resolved in some way, the stocks that surged 8% are going to go back down to earth, rare earth. And let me see. Okay, so China is now requiring foreign entities to obtain a license to export products that contain rare earths. So they're really putting the screws down on who can have access to rare earths. And they don't want the United States to have, China doesn't want the United States to have rare earths because they'll make bombs with them, which will be used on them. So who would want to export something that's going to be hurting them? Okay, and so what I thought would be interesting with this news story about rare earths, let's go over the financials of one of these companies. The biggest one is MP Materials. You can see they jumped like doubled in 1 week recently. That's because the government was backstopping the price of their commodities that they make, and they invested in the company. So there's a guarantee basically that the company is not going to go out of business because it's a critical business for the United States government. So whenever you have the backing, financial backing of a big client, people have more confidence. So let's look at their numbers. The forward PE is 81. That is pretty high. Trailing PE is 20. Um, I looked at their profitability. We have negatives. So this company, it's kind of sketchy. It hasn't had earnings uh, recently or in the past 10 years. And all of a sudden it is, there's a lot of investments being made by the government, Apple, GM, um, that will allow it to become profitable because it produces rare earth minerals that they can't get from China. So the cons are inconsistent earnings and unknown profitability. Warren Buffett, I don't think would take a risk in this stock because Warren Buffett likes to buy stocks that have a consistent positive earnings growth and dividends. Um, okay, so let's look at what CFRA says about MP Materials. They have a strong buy with a 74, $90 price target. That's almost 30% more than it is now. They say our five-star strong buy opinion reflects on MP's competitive advantage supplying um, minerals to North America for electrical motors, wind turbines, and robotics. The Department of Defense partnership transforms them from being a simple cyclical miner to strategically protected asset with guaranteed cash flows. So anyone that was worried about MP Materials going out of business basically covered. Covered meaning there could have been a short squeeze right here where people that were short on the stock covered their short positions, and that cost a lot of buying for that. Okay, so let's look at what not again. A lot of times when there's small cap stocks or stocks that are kind of sketchy, CFRA doesn't give a fair value. So it's really hard for me to have confidence in a stock that we can't find the actual numbers for it. You can see that they haven't had good earnings that are consistent ever, it seems. So it's kind of a sketchy company. I mean, it doesn't have any price to earnings ratio, but they're guaranteed now that sell anything they make above market price. So that is all a good sign that they're most likely going to be profitable going forward. But it's a sketchy stock right now. I wouldn't Warren Buffett wouldn't touch this. Um, it's it's a lot like some of the AI stocks and some of the quantum stocks that there's no earnings now, but there's a promise of earnings in the future. Okay, let's look at okay, so we were talking about this last week. How do you invest during a bubble? Let's review that. Grantham said the S&P is up. Oh yeah, here's a problem with people. There's a lot of people that predict a bubble, and they say get out of stocks now because it's going to crash. This guy Grantham said that last in 2021, and just when he said that, the S&P is up 90% since when he wrote that. So I guess the moral of the story is it's time in the market, not timing the market. And, and whenever you have some of the stocks going up a lot beyond their valuation, you just have to understand that um, it isn't what the stock is trading for today. It's what's going to be worth 10 years and 20 years down the line. And you can't um, you can't necessarily throw out every stock that's going up during a period of time when we have a good market like this. So let's keep our eyes on this bubble and see if we see any of the more expensive stocks coming back. But if we look at this news story, here's the way I translate it. Trump puts extra 100% tariff on China. That'll cripple like every major company in America if you do that. That means Walmart would have to basically double their prices for a lot of Chinese goods, and they'll lose sales. It's going to be like a logistic nightmare. But Trump said the same thing basically in April, and then he walked it back. So you can invest on headlines, and whatever you do, don't start selling something based on wild Trump comments or posts, because then it defeats the purpose of buying and holding. All right. So that's all I had to say for today. I hope you enjoyed that. Um, but that. All right. Well, I'll see you next time.